On June 9, 2024, a story broke that the U.S. Dollars Foundation had just collapsed. A 50-year secret agreement between the United States and Saudi Arabia, signed in 1974, guaranteeing that Saudi oil would only ever be sold in dollars, had quietly expired. Saudi Arabia wasn't renewing it. The post went out on social media, and within days it had over 1 million views. Financial commentators warned of dollar collapse. Crypto forums declared victory. The story had a date, a treaty, a 50-year countdown clock ticking down to zero. There was just one problem. The treaty never existed. No such 50-year agreement was ever signed. No expiration date was ever written into any American or Saudi document. The U.S. Government Accountability Office confirmed it. Economists confirmed it. Fact-checkers on 3 continents confirmed it. The story that convinced 1 million people the dollar was dying was, in the most literal sense, fiction. But here is what almost nobody covering that story understood. The fake collapse was hiding a real one. While the internet was arguing about a treaty that didn't exist, Saudi Arabia was quietly doing something far more consequential and far less dramatic. No press conference, no countdown. Just the slow, structural unwinding of an arrangement that has underwritten American financial power for half a century. This is the story of how that arrangement actually worked, why the myth about its death went viral, and what is genuinely replacing it while everyone was looking the wrong way. Here is the strange thing about the petrodollar system. Almost everyone talks about it, and almost no one can point to the document that created it. That's because there isn't one. The dollar's grip on global oil trade was never written into a treaty the way people imagine. It emerged the way most durable forms of power emerge, not through a single signature, but through decades of accumulated convenience, dependency, and mutual interest that eventually became so normalized it looked inevitable. Go back to 1974. The U.S. and Saudi Arabia did sign something that year, a joint commission on economic cooperation. It was real, but it said nothing about currency. What actually happened alongside it was kept secret for over 40 years. An informal understanding where Saudi Arabia would keep recycling its oil revenue into U.S. Treasury securities, and in exchange, the United States would keep the security guarantees flowing. Protection for the Saudi royal family, military hardware, an implicit promise that American power would stand behind Saudi stability. Bloomberg didn't reveal the details of that arrangement until 2016, more than 4 decades later. This is the first thing people get backwards about the petrodollar. It was never really about oil being priced in dollars. Oil had already been priced predominantly in dollars since the Bretton Woods era, simply because the dollar was already the world's reserve currency. What Saudi Arabia actually provided wasn't a pricing commitment. It was a recycling commitment. Dollars earned from oil went back into American debt markets, into American banks, into the financial architecture that let the United States run deficits other countries could never sustain. The mechanism wasn't a currency rule, it was a circulatory system. And that's exactly why the expired treaty story was able to spread so fast in 2024. People wanted a single dramatic point of failure, a date, a signature, a moment. Real institutional decline almost never works that way. It doesn't expire, it erodes. And erosion doesn't trend on social media because there's no clip of it happening. There's just a 50-year current account surplus quietly turning into a deficit while the world argues about a treaty that was never real. To understand what's actually shifting, you have to understand what the petrodollar arrangement was built to do, and why it worked for as long as it did. Monetary dominance isn't primarily about force. It's what political economists call structural power, the ability to shape the environment within which everyone else makes decisions without having to constantly issue commands. The United States didn't need to force Saudi Arabia to hold dollars. It needed Saudi Arabia to conclude, year after year, that holding dollars was simply the rational choice, safer, more liquid, and backed by a security relationship worth protecting. That's a very different kind of power than a treaty. A treaty can expire. A rational calculation has to be replaced by a better one. For 50 years, nothing came close to replacing it. American Treasury markets offered depth no other market could match. Hundreds of billions of dollars in daily trading volume, deep enough to absorb the entire reserve holdings of an oil-producing state without moving the price. American security guarantees offered protection no other power was willing or able to provide at the same scale. And the entire architecture of international oil trade, pricing conventions, hedging instruments, the correspondent banking system, had been built around dollar denomination for so long that switching away from it wasn't just a policy decision, it was closer to rebuilding a piece of global infrastructure from scratch. That is what has to be understood before anyone can talk seriously about de-dollarization. It was never a switch a country could flip. It's closer to a building constructed on a foundation nobody has laid anywhere else. Saudi Arabia's leverage never came from threatening to sell oil in another currency tomorrow. It came from the much slower, much more consequential fact that its own economic position, the very thing that made the dollar arrangement worthwhile in the first place, was quietly changing underneath it. In the 1970s, Saudi Arabia's current account surplus regularly exceeded 50% of its GDP. The country was accumulating dollars faster than it had productive uses for them, which is exactly why recycling those dollars into American debt made sense. There was nowhere else for that volume of capital to go. By the mid-2020s, that surplus had collapsed to a fraction of a percent, with analysts projecting the country moving into deficit as domestic spending, Vision 2030 diversification projects, and demographic pressures absorb revenue that once flowed outward. A country running a shrinking surplus and eyeing a deficit is not a country with unlimited dollars to recycle. It's a country that has to start asking, for the first time in half a century, what its financial relationships are actually for. That is the real mechanism, not a treaty lapsing, a structural transformation in what Saudi Arabia needs from its own economy, and therefore in what it needs from the United States. Here is the uncomfortable part, and it's the part almost none of the viral coverage got right. While people were debating a fake expiration date, the real diversification had already been underway for years. Saudi Arabia had been in active discussions with China over yuan-denominated oil sales since at least 2022, quietly, incrementally, without a single dramatic announcement. China had launched a yuan-denominated oil futures contract as early as 2018. Saudi Arabia's formal engagement with the BRICS grouping has moved forward in fits and starts, alongside a broader pattern of diversifying reserves and deepening economic ties with Beijing that has nothing to do with any 1974 paperwork and everything to do with where the country's economic center of gravity is actually moving. None of this means the dollar is being replaced overnight, and a serious analysis has to resist the same trap the viral story fell into, just in the opposite direction. Saudi Arabia is not abandoning the dollar. It is hedging against total dependence on it, which is an entirely different and far more revealing thing to watch. The country still needs American security guarantees more than it needs any single currency arrangement. Those guarantees are precisely what a 2024 strategic alliance negotiation between Washington and Riyadh was built around. Discussions that received a fraction of the attention the fake treaty story did, despite being the actual substance of the relationship. This is where the deeper pattern in monetary power reveals itself. Reserve currency dominance was never a fixed asset. It behaves more like a lease that has to be continuously renewed by demonstrating that the underlying relationship, security for financial cooperation, still delivers more value than the alternatives. For 50 years, no alternative came close. Now, for the first time, one exists in rough outline: Chinese demand, Chinese infrastructure investment, Chinese willingness to buy oil in a currency other than the dollar. It isn't yet a replacement. It's a second option, and the mere existence of a second option changes the negotiation permanently, even before a single barrel changes currency. That is the shocking realization underneath this entire story. The 2024 panic-imagined dollar dominance ending with a bang. A signed contract, a public announcement, a clean date on a calendar. The actual erosion is happening exactly the opposite way. Quietly, gradually, driven not by any single decision but by a decades-long shift in Saudi Arabia's own economic structure that most people covering the collapse never once mentioned. So what should you actually take away from this, once the noise is stripped out? First, monetary power is structural, not contractual. It doesn't rest on documents you can point to, and it doesn't end when a document expires. Because in this case, there was no document to begin with. It rests on whether the underlying relationship, security for financial loyalty in this case, still makes rational sense for both sides. That is a much harder thing to track than a treaty date, and it is exactly why most coverage of de-dollarization gets the timeline wrong in both directions. Too alarmed about sudden collapse and not alarmed enough about gradual structural change. Second, the real signal was never going to come from Washington or Riyadh announcing anything. It was always going to come from balance sheets. A current account surplus falling from 50% of GDP to near zero. A country transitioning from capital exporter to capital importer. A set of quiet negotiations with a rising alternative power that never needed a press release to matter. Institutional change of this kind rarely announces itself. It shows up first in the numbers nobody is watching and only becomes a headline once the shift is already largely complete. Third, and this is the part worth sitting with, the next major test of dollar dominance almost certainly will not look like a viral treaty story either. It will look exactly like this one did before it went viral. A gradual accumulation of structural pressure, visible in trade data and reserve composition long before it's visible in any news cycle. Understanding the difference between the dramatic story and the real one is, in the end, the entire discipline of institutional analysis. The viral version gets the clicks, the structural version gets it right. What we've walked through here, why oil got priced in dollars in the first place, how that arrangement became a source of durable American power, and why states like Saudi Arabia are now hedging against it without ever formally breaking from it, is really a single chapter in a much larger question. What actually happens when states try to escape a currency system that has structural advantages most people underestimate? That's the exact question I spend a full book working through. It's called the de-dollarization dilemma, and it goes much deeper into the mechanics we only had time to sketch here. The network effects that make dollar dominance so hard to displace, the institutional trust that alternatives haven't yet built, and the plausible scenarios for where this actually goes over the next decade. If this episode raised more questions than it answered, that book is where I answer them. I'll leave the link in the description.